Welcome back. It's time for our special segment, Quarter Se Quarter Tak. We bring you earnings expectations from various sectors, and Vamakshi today is going to tell us how the setup for the capital goods space really is looking like. Vamakshi, over to you.
Well, absolutely. It has been a dream run for capital good companies so far. In fact, in the quarter ended March, on an average, the industry is expected to witness a nearly 16% growth in the revenues, and this will be supported by strong execution as well as record high order book across most of the companies. Cost saving measures as well as operational efficiencies could lead to a nearly 14% jump in the EBITDA. However, the margin outlook remains mixed. On the profitability front, however, a 17% jump on an average is expected across companies. Now, while the order flow has been robust in the recent quarters, a slight moderation is expected this time around, and that is mainly on account of the elections. Nonetheless, steady order inflows are projected in segments like renewable energy, power, transmission and distribution, as well as defense. Private investment has been selective so far, is also seeing some green shoots. So overall, the order momentum is expected to pick up meaningfully only after Q2 of FY25. Export orders, however, are a concern given the sluggishness in most geographies, geopolitical tensions, as well as trade disruption. Now, against this backdrop, all companies are forecasted to achieve double-digit revenue growth across the board, and on an average, this ranges between 13 to 25%. Margin projections vary. GE T&D, Kirloskar Oil and ABB India are expected to witness expansion anywhere between 1 to 6% in their margins. BHEL, Siemens and to some extent Thermax, however, may see some pressure. With the exception of BHEL and CG Power, net profits are expected to climb for most of the companies. Now, in terms of stock performance, capital good companies have seen a very strong surge with returns exceeding nearly 75% across the board for all companies. In fact, on a year-to-date basis as well, the stocks have gained anywhere between 18% to an impressive 114% for some counters. However, this strong surge has in turn pushed current valuations above the historical averages, and the question still remains, can these premium valuations sustain? Will private capex drive the next leg of growth for these capital good companies? Well, only time will tell.
All right, thanks a lot for that. Renu Baid joins in. She's been tracking this space very closely for a long time. Renu, welcome to the show. In your coverage universe, which are the stocks that you're most bullish on this earnings season?
From an earnings perspective, this season, I think companies like Bharat Electronics, ABB, Cummins, data and small cap space companies like Data Patterns, and even EPC companies like KEC Kalpataru from the lower base should bounce back strongly on the earnings side. But names like CG Power, Siemens and Thermax will just see barely single-digit growth in earnings because of a very high base last year. So to that extent, we expect some moderation on the earnings side for some of the diversified industrials.
But for stocks like BHEL, just one follow-up there. I mean, they've rallied substantially, right, in the last 1 year. So do you see valuation headroom as well, or are you cautious because of the kind of rally we've seen?
We don't have a formal coverage on BHEL anymore. But yes, I think the rally primarily has been on the back of very strong reversion in terms of the order inflows for the thermal power. Execution, balance sheet repair is yet to be seen. So I think that is where one sees disconnect between valuations and the on-ground fundamental earnings outlook. So it's primarily linked to the revival of the thermal ordering cycle.
Renu, hi, morning, Prashant here.
Hi.
What is when you speak with investors, what do they want to see? Is it just order books which continue to grow? Is it now execution? Is it improvement in profitability? What is the real, if there is one dominating driver, which will drive share price performance from here for the sector?
The lead indicator for the sector has always been order inflows. And time and again, investors look that as an anchor to peg their earnings outlook, forward earnings outlook. So I think order inflows have been the key. If I have to put one single catalyst, it's that. But it's just not order inflows. Investors also look for execution efficiencies, profitability. So the stock performances eventually are a factor of all of these elements. But yes, if it's one single element deciding factor, then it is order inflows as the headline number, as an indicator for future growth.
Okay, all right. Hi, Renu. Good morning. Nigel on this side. I had a two-part question. Since we're getting to elections, the government's order inflow could slow down a little bit. So are you bracing for a soft first half of the year and then a recovery in the second half of the year? So that's on the government spends, which actually has been very, very good. And on the other part of it, private capex is expected to pick up. Are you seeing green shoots?
So in terms of order flows, it's customary for election-related slowdown in order flows. That is already priced in terms of the assumptions for fourth quarter partially and for the first half of fiscal 25 across companies. So be it names like Larsen, where we have seen in the current fiscal almost 40% growth in the order inflows is expected. Next year, we are actually expecting a decline to flattish inflows for Larsen. Same for other companies, at least for the first 6 months, we're expecting flattish to marginal softness in order flows. On the private sector, also large ticket size greenfield projects, be it steel, cement, etc., could see some moderation in finalization during this election period. But nonetheless, towards the second half, we expect these to catch up. So I think overall, private sector has been holding up. The large ticket size orders from core sectors will see finalization in the second half of the current calendar year. Otherwise, I would broadly say the capex cycle should hold, and if government is able to execute well on certain reform activities in the power sector and key rolling stock ordering on the railway side, one will see a meaningful pickup in order flows in the next 2 years for the sector overall.
You know, for Larsen, Renu, there was some news flow that the Saudis are lowering what they're going to spend on this new city, which they were building. I mean, some dramatic cuts. Of course, other development work, etc., in that part of the world is going on, but that was a single large. I think it was spent some $500 billion or something. At least that was a number which was put out. Is the pickup in Middle East as a large contributor a big reason for the share price performance we've seen recently, and is this a dampener?
For Larsen?
For Larsen, L&T.
Yes, as in for L&T, Saudi and hydrocarbons specifically have been one of the biggest driver for order flow growth in fiscal 24. And some of the news flows and announcements from if you look at Saudi Aramco, and even as a region to slightly consolidate the spending has been a bit of sentiment dampener. But practically from an order inflow perspective, because some of these projects and city development are long-drawn projects spread across 4 to 5 years. In terms of on-ground ordering activity, I don't think so there is much derailment. But yeah, the pace of order finalization and especially the current geopolitical tensions could add incremental risk elements to projects in the region there.
All right, Renu, we'll let you go on that note. Thanks a lot for joining in. Appreciate your time here.